Well, hello, everyone. Welcome back to Finance Friday on the ARC UK YouTube network. I'm Hard Money Jim, speaking today from beautiful Coronado, California, where my family and I have come to escape the frigid Wyoming winter. So let me share a screen with you here. And here is a photo of my backyard in Jackson Hole. Last Wednesday, just before we hit the road for the long drive south here. It was about 6 below. And those are all our friends, the elk on the elk refuge. And here is where we'll be spending the rest of most of this winter. Lots of sunshine, and it's pretty warm too. It's quite a contrast. All right, so that's enough for the travelogue for today. You probably don't want to hear too much of that. So, but let's check out. Excuse me, I got an airplane flying over, and I want to be sure you can hear me. Let's check out what's going on in the world of money creation and its consequences, which is what we're all about here. About a week ago, on November 30th to be exact, something caught my attention. I saw a news report that a person named Sam Bankman-Fried, also known as SBF, who's the CEO of the FTX crypto exchange, and now one of the most famous frauds in all financial history. I heard that he was, despite the sudden public bankruptcy and disgrace and obvious fraud and exposure of his activities in his company, that he would still be a featured speaker at a prestigious New York Times financial conference called the New York Times Dealbook Summit. And this is the New York Times promotion that caught my eye. And I noticed right away that he was sharing the program with the former chair of the Federal Reserve, Janet Yellen, along with several other luminaries. You can see there Mark Zuckerberg and Volodymyr Zelensky. Now, seeing this criminal, Sam Bankman-Fried, together with Janet Yellen, the former Fed chair and current Treasury Secretary, I immediately made a connection that I thought was worth sharing, because there is an important but not obvious connection between modern central bankers like Yellen and swindlers like this young man, Sam Bankman-Fried, whose name, frankly, should be remembered as Sam the Bankster Fraud, and I may refer to him that way several times today. Now, I'm not claiming that both Fried and Yellen are both swindlers or criminals. Only one of them is, only Fried. He is actually a crook. But there is a strong connection between them that we're going to talk about today. Now, first, for those of you who are not very familiar with the FTX fiasco, I just want to mention a few points essential to this discussion. I don't want to delve into the particulars of what bad things Fried and his associates did. There's many places you can read about that, and it is still a developing story. But what is important for this discussion is that SBF ran a financial exchange, an online marketplace where you could trade crypto tokens or fiat money of any kind with other people on that exchange. FTX, his business, took in dollar deposits as well as crypto tokens, and they made a market in those items. Now, there's nothing wrong with that, of course, but SBF apparently was not content to run an honest exchange. Among other antics, SBF offered to borrow his customers' coins so he could re-lend them to speculators, and then he promised low-risk returns on those loans of up to, are you ready, 18%. So even if you believe his recent claim that FTX's exchange was undone by sloppy accounting and carelessness rather than intentional fraud, the fact is that FTX advertised itself as a secure crypto exchange. If you attract customer money by saying that you have a well-run lending system when you really don't, and then you lose your customers' money, and then you say, oops, we didn't mean to do it. Well, that's bad, even if that's true. But in other words, attracting customer money with lies and then losing it by accident is, to me, just as bad as attracting customer money with lies and then stealing it. It's fraud either way. And right now, it appears that SBF stole something like $8 billion in customer deposits. The number's still uncertain as we speak. And through this fraudulent lending and borrowing and posting phony price quotes, he spent that money on everything from real estate in the Bahamas to making huge political donations, in addition to incurring huge trading losses. The latest reports are calling this guy, SBF, the biggest fraudster in modern financial history. Bigger than Jeffrey Skilling of Enron, bigger than Bernie Madoff, and bigger than Elizabeth Holmes of Theranos, who just got sentenced to 11 years in prison for her fraud. Now, SBF's fraud occurred over the last 2 to 3 years, coinciding with the greatest asset bubble ever experienced in the financial markets. I contend that this is not a random coincidence. So what is the connection between central bankers like Janet Yellen and frauds like SBF? The connection is inflation. Yellen and other central bankers enabled Sam Bankman-Fried. Janet Yellen and other central bankers cause inflation, and Sam Bankman-Fried cashes in on it, at least until he's caught. Now, here at Hard Money Jim, we're all about money creation and its consequences. And here is a case where that perspective can improve your understanding. You would never see the connection between inflation and fraud if you simply held that the Fed's view of inflation, which, according to Bernanke and Yellen and Jerome Powell, is simply rapidly rising consumer prices. If you accepted that definition, you'd think, oh, here we have inflation, consumer prices are rising, and in addition, just by coincidence, we've had this big scandal surrounding the FTX cryptocurrency exchange. Those are just two noteworthy things that just coincidentally happened at the same time. That's what you would think. But constant subscribers to this forum know better, because we know that inflation is properly defined as excessive money creation caused by government action, and that rising consumer prices are only one of the important consequences of that action. And what may surprise you today is that big scams like the one just perpetrated by Sam the Bankster fraud are also a result of the Fed's inflationary process. So I am saying that money printing causes a decline in the moral standards of the culture, and that this decline enables fraud on a broader scale than what would otherwise have occurred. Now, I'm not saying that inflation, that is money printing, is the only cause of financial fraud. No, but I do contend that inflation sets us up for bigger, more widespread fraud than what would have otherwise happened in a sound money environment. And more precisely, I think fraudulent money creation, inflation, is both a cause and an effect of declining standards of honesty, independence, and personal responsibility in our culture today. By both cause and effect, I mean that when a government debases a currency, it's taking a first step in the process of the moral debasement. But once the government has gone down that road, the monetary debasement itself encourages public behavior that then further undermines the integrity and the character of the average investor. So it can become a vicious circle. Now, in this forum, we often discuss how government creates inflation. That is how the currency debasement starts. But we have not discussed very much some of the secondary effects on the morals of the culture. So today, we want to ask, how does inflation, properly understood as an undue increase in the stock of money, how does that degrade the culture right down to undercutting the personal character and typical the personal character of the typical investor, or maybe even the typical citizen? And after we discuss that question, we want to talk about how you can avoid the ethical trap that inflation wants to put you in. And we'll discuss what practical things you can do, some mental habits you can adopt to retain what going to call your ethical sovereignty in this era of unethical money production that we certainly live in. Now, to set the stage, let's focus not on this guy, SBF himself. Let's look at the millions of people who gave him their money, the people who bought into his story, and all those who believed his fraud. Why were these people so easily duped into giving this guy their money? Who were these people? Do not be tempted to think it was just the gullible, little, unsophisticated people, little investors who fell for SBF's fraud. Yeah, there were many small investors who sent real money to FTX, and many were full of hope that they'd make a fortune trading crypto tokens. And some of those small investors lost their entire life savings. But there were many others caught up in the hype. This graph shows an estimated market capitalization of all cryptocurrencies. And look at the peak there in November 2021. That was just a year ago. This market cap reached a little over $3 trillion. That's with a T. Now, FTX had been founded only 2 years later in 2019. So pretty clearly to me, FTX was riding a wave of unwarranted enthusiasm and overconfidence in the entire cryptocurrency story. There were a lot of suckers here, and they fell into a number of categories. First, there were celebrities. Matt Damon, Tom Brady, and his former wife, Giselle, what's her name? Larry David, LeBron James, Steph Curry, Mark Cuban, Snoop Dogg. The list is very, very long. The Miami Heat's stadium was named FTX Arena. And University of California, Berkeley's football field was just until recently going to be called FTX Field. This slogan, "Fortune favors the brave," that was touted by Matt Damon, was a slogan used to entice people to send in their money. Then, in addition to the celebrities, there were the high-profile politicians who shared many public presentations with Sam Bankster-Fraud. These were people like Bill Clinton, Tony Blair, Barack Obama, and the list goes on. They were attracted to SBF by both the crypto myth, I would suppose, and the money, because SBF was reportedly the second largest donor to the Democratic Party at $40 million, second only to George Soros. SBF also gave some money to Republicans, by the way. For example, we know Mitch McConnell got some money. We just don't know how much. The point is, I'm not being partisan here. The point is, SBF was clearly trying to buy favors from politicians. There are even allegations that the government of Ukraine invested money in FTX, some of which was then recycled back to the Democratic Party to fund their midterm election campaign. Now, I don't know how true this is or if it's true. The point is, we don't know where that Ukraine money went, and it sure looks like Volodymyr Zelensky fell for the scam as well. Now, this is one that I think is really interesting, this photo. And this is one I would take special attention to. This is Maxine Waters. She's the chair and ranking member of the House Financial Services Committee. She oversees financial services. Whoops, let me get back there. She oversees financial services. I mean, she's a consumer advocate. You'd think that she'd be circumspect about posing with a 30-year-old kid who claims to be reinventing financial services. I mean, does she know anything? Will she believe anything as long as it gets her a campaign contribution? Her endorsement of SBF undoubtedly gave others confidence in him, and shouldn't she have been more careful? There were also some famous bureaucrats. 6 months before the bankruptcy, which was just like a couple of weeks ago, SBF even had a meeting with Gary Gensler, the head of the SEC, who was reportedly coaching him on how to advocate for a regulatory structure that was favorable to his business. Now, what was Gensler's connection to Bankster Fraud? Well, Gensler was formerly a student at MIT, where a professor that he's friendly with is the father of Caroline Ellison, SBF's head trader and part-time girlfriend. Here she is. So we had celebrities and politicians and government officials all piling on, all buying into this fraud, and all acting like true believers. But to me, the worst offenders and the biggest suckers were the professional investors. And among professional investors, we see the evasion and the loss of rational standards and the wanton waste of good money by those who make a living investing the life savings of many average people, including literally proverbial widows and orphans. Now, this shot is from the website of Sequoia Capital, a large and very famous venture capital firm that invested $214 million into FTX. And to illustrate how willfully gullible some of these professional investors were, I want to look at a transcript of a Sequoia due diligence conference call with Sam Bankman-Fried. This was a call designed specifically to smoke out the kind of hype and empty claims of companies like FTX who are looking for investment funds. So to set this up, after a Zoom interview with Bankman-Fried, during which no financial documents were reviewed, these highly trained professional financial analysts at Sequoia lit up the Zoom chat function with the following comments. And now I'm quoting from a research piece called Epsilon Theory by one good analyst named Ben Hunt. We had a great meeting, quote, "We had a great meeting with Sam, but the last question, which I remember Alfred asking, was, so everything you're building is great, but what is your long-term vision for FTX?" That's when SBF told Sequoia about the so-called super app. "I want FTX to be a place where you can do anything you want with your next dollar. You can buy Bitcoin. You can send money in whatever currency to any friend anywhere in the world. You can buy a banana. You can do anything you want with your money from inside FTX." Suddenly, the chat window on Sequoia's side of Zoom lights up with partners freaking out. "I love this founder," typed one partner. "I'm a 10 out of a 10, pinged another. "Yes," exclaimed the third. Sequoia was reacting to the scale of SBF's vision, apparently. It wasn't a story about how we might use financial technology in the future or crypto or a new kind of bank. It was a vision about the future of money itself, with a total addressable market of every person on the entire planet. I sit, quote, "I sit 10 feet from him, and I walked over thinking, oh shit, that was really good," remembers someone named Aurora. "And it turns out that so-and-so was playing League of Legends throughout the entire meeting. We were incredibly impressed. It was one of those your hair is blown back type of meetings." Now, I have been in many, many due diligence meetings, some with people trying to get my firm to invest our clients' money in snake oil. I did exactly this job for 20 years. And the way my firm operated, all of us, was to start with written disclosure by the firm in question, many pages of accounts and financial statements, then tear those documents apart before the meeting. And then on the day of the due diligence, we would grill the company CEO or his representative to uncover any possible flaw in their investment story. Our starting point was skepticism and doubt. We asked tough questions. And this obsequious, adoring attitude displayed by these Sequoia analysts is worlds away from anything I ever experienced in a due diligence meeting. So SBF obviously had them all buffaloed. All of them were in awe. All he had to do was play video games while chatting up the analysts, making him think he was so smart and confident that he could multitask with a video game and a vision for a world currency both at the same time. I mean, really? I mean, what made these people, the clients, the celebrities, the politicians, and even the professional investors so gullible? And how did inflation play a role in this deception? So let's go back about 13 years to answer that question, to the beginnings of quantitative easing and to get a grasp of how inflation sets us up to swallow fraudulent schemes like this. Now, here's an explanation for QE by Ben Bernanke in his famous Washington Post op-ed of November 2010. It's called What the Fed Did and Why. Here's what he said. Lower corporate bond rates will encourage investment, and higher stock prices will boost consumer wealth and help increase confidence, which can also spur spending. Increased spending will lead to higher incomes and profits that, in a virtuous circle, will further support economic expansion. So Bernanke thought that by creating money to buy bonds, he could lower interest rates, increase stock prices, and increase spending, which would somehow increase real wealth. He called this the wealth effect. To him, it's a confidence game, a typical Keynesian notion based on psychology rather than the production of real goods and services. Now, he and his successors continued their program of QE for many years, with only a few interruptions, for 13 years. They created almost $7 trillion of new money, most of which was spent in the stock and bond markets, causing asset prices to rise for years with only a few interruptions. They did not yet see a significant rise in the consumer price index, so they assumed they were not causing, quote, inflation. They never explained why they thought soaring asset prices is not inflation, while rising consumer prices is inflation. This chart from the Fed shows the Fed's assets that were accumulated over the QE period, basically from 2009 to 2022. And remember, this is important because for every dollar of new Fed assets, there's a new dollar of new money created in the banks, which, as I said, was mostly spent on investment assets. And here is the result that occurred in the stock market, which responded just as Bernanke expected it would. The orange line is the Fed's assets, or new money, and you read that on the right scale. The black line is the value of the S&P 500 stock market index, which you read on the left scale. The Fed's monetary stimulus was not a one-time thing. QE, or just plain money printing, became their only policy, and it went on for many years. Every time the stock market hiccuped, the Fed pumped more money into it. And investors responded. They learned to depend on that flow of new money. Interest rates fell too low to support savings, so investors learned to speculate in the stock market. The broad market went up over 500% during this 13-year period, at the same time that interest rates plummeted to nearly zero, making ordinary saving impossible. The biggest bubble of all was during the pandemic. You can see it on the far right of this graph, where the lines go almost vertical. And that's when money printing took on new meaning. Money supply went up 40% in 2 years. House prices went up 30 to 40%. Stocks soared to new heights. And the market cap of cryptocurrencies hit 3 trillion. This was the everything bubble. Now, what should we expect from investors, especially young investors, after years of this kind of monetary condition? Will they be careful, risk-averse savers, or are they going to feel compelled to speculate in programs they don't understand? Do you think this kind of one-way market would attract hard-nosed analysts, or would it attract feverish gamblers? And just look at the stock market even today after the Fed has started tightening, that is raising short-term interest rates, and the broad market now is down 15% or so from its peak. Every time the Fed even hints it might slow its tightening schedule, the market rallies 3 to 5%. It's responding to the prospect of more cheap money. But the only reason the Fed would slow down that tightening program would be if they thought the economy was getting worse, that is, getting closer to a recession. So that means a bad economy, that is, slower growth and higher unemployment, is what the stock market seems to want, because only a bad economy will make the Fed give us more printed money. This means good news in the real economy is bad news for the stock market. And think how bizarre that is. Stock traders think those making the market at the margin, think a poor economy means a bull market for stocks. good financial performance and a booming economy don't matter. In fact, they're considered to be negative today. It's all about the Fed, and it's all about the Fed's next move. The market is addicted to liquidity, that is, to easy money. Now, the veteran economist Jim Bianco, who I respect greatly, summed it up this way. He said, in 2023, it's all about liquidity and it's all about money. The hope in the stock market is the economy turns down when the Fed pivots and cuts rates and the market responds positively. This is the upside down world we are in. 15 years of quantitative easing, zero interest rates, negative interest rates, and forward guidance have got the market to become like a liquidity junkie. It only wants cheap money. It only wants low rates. And that is all it responds to. Other veterans on Wall Street echo that analysis. For example, David Einhorn of Greenlight Capital said in a recent interview, nobody knows what anything is worth, he said. He's a multi-decade veteran, and he says most market participants today don't actually know how to value a company anymore. It's a lost art. Quote, nobody is actually doing those calculations, he says. So inflation or money printing creates this illusion of wealth that makes people believe they're rich. But the fact is, printed money does not create new wealth. Some people get rich simply because of inflating asset prices, but at the level of the entire economy, there's no new wealth created. Just think, if the share price of a widget maker goes up 10% because of money printing, has the ability of the widget maker, has the ability of that firm to produce widgets increased? No, it just costs more dollars for an investor to buy the shares of the widget maker. The owner of the widget stock gets richer relative to everyone else, but widget consumers and new potential widget investors are penalized. So after years of this Fed money printing and higher share prices that have no relationship to the underlying financial fundamentals of the companies, what do people resort to? They resort to speculative trading, options trading, derivatives trading, and all this is more akin to gambling than investing because most of these new speculators do not know what they're doing. Here's a quote from the late, great Henry Hazlitt to sum up this point. Quote, inflation discourages prudence and thrift. It encourages squandering, gambling, and reckless waste of all kinds. It often seems more profitable to speculate than to produce. Inflation tears apart the whole fabric of stable economic relationships. Its inexcusable injustices drive men toward desperate remedies. It plants the seeds of fascism and communism. It leads men to demand totalitarian controls. It ends invariably in bitter disillusion and collapse. That was written decades ago. Okay, let's stop here, Daniel, and respond, see if there are any questions or comments before I go on.
Yes, we have a couple of super chat. One from Mary Ellen. Thank you so much. Another one from Mary Ellen. She also says, do any of these four know money and finance? And I think it's referring to the four people you showed at the start.
The four people we showed at the start?
Yeah.
Do they know money and finance? If you were speaking of Sam Bankman-Fried, Mark Zuckerberg, Janet Yellen, and Vladimir Zelensky, those four?
Yeah.
If those are the four, then at least three of them do understand a good bit. Sam the bankster fraud knows. He is not stupid. Now, what he put together was a very ingenious scam. Janet Yellen is a PhD in economics. She's the Treasury Secretary. She is the former head of the Fed. If anyone should know money and finance, it should be her. And Mark Zuckerberg is also no dummy. Now, I'm not, by the way, he's just on the screen with those people. I'm not casting any aspersions at Zuckerberg in this light. So I think if I'm answering your question, yes, there should be extensive knowledge of how money and banking work among these people. I wouldn't put Janet Yellen in a fraud category, but I think there's a certain cynicism with her. she says things that she knows cannot be true. Recently, for example, I won't go on talking about this, but recently she was blaming inflation. I almost put the quote in here. She blamed inflation, but she thinks they're rising consumer prices. She was blaming it on the lockdown behavior of consumers. She was literally saying, "Oh, people went out and they stayed at home and they didn't have anything to do, so they bought barbecue grills and other things for their home, and that's what caused consumer." I mean, it was ludicrous, and she knows better. She was blaming consumers for inflation. All right, I'll stop.
And then we have a super chat from Kirk who says, "Big money Jim is always on the money."
What was that? Big money what?
Big money Jim is always on the money.
Oh, no, it's hard money, Jim. Oh, well, I appreciate that. I am not always on the money. All right.
And last super chat from Dwayne. Thank you so much.
Thank you, Dwayne. Thank you much. Okay, I want to say just a bit more about the effects of inflation on the moral fiber of the culture. And here I want to quote from a source I've referenced before. Maybe some of you will remember, many of you will not. It's from a 125-year-old monograph called Fiat Money Inflation in France by a man named Andrew Dixon White. Now, White wrote about the great inflation leading up to the French Revolution and how inflation literally changed the character of the people of France. And the point of referring to this somewhat ancient account is to illustrate that fiat money always has similar effects on the people and on their culture. 100 or 1,000 or 2,000 years ago. Now, White first points out that Frenchmen were naturally very thrifty people, but that inflation changed that. Quote, "The great majority of Frenchmen now became desperate optimists." This is 1791. Declaring that inflation is prosperity. Throughout France, there came a temporary good feeling. The nation was becoming inebriated with paper money. The good feeling was that of a drunkard just after his draft. And it is to be noted as a simple historical fact, corresponding to a psychological fact, that as drafts of paper money came faster, the successive periods of good feeling grew shorter. Still another difficulty appeared. There had come a certain complete uncertainty as to the future. No one knew whether a piece of paper money representing 100 livres would a month later have the purchasing power of 90 or 80 or 60 livres. The result was that capitalists feared to embark their means in business. Enterprise received a mortal blow. Demand for labor was further diminished. The business of France dwindled to a mere living from hand to mouth. This state of things was still more ruinous to those in moderate and most of all to those in straitened circumstance. With the masses of the people, the purchase of every article of supply became a speculation. But these evils, though great, were small compared to those far more deep-seated signs of disease which now showed themselves throughout the country. One of these was the obliteration of thrift from the minds of the French people. A loose luxury spread throughout the country. A still worse outgrowth was the increase in speculation and gambling. And he goes on, about how he ends up by saying, "What a prospect for a country when its rural population was changed into a great band of gamblers. Even worse was the breakdown of the morals of the country at large, resulting from the sudden buildup of ostentatious wealth in a few large cities." And he goes on. It's really quite eloquent, and I recommend it. Fiat Money Inflation in France, it's called. And it's available for free on Mises.org. Now, White, in this monograph, documents the rise of betting instead of honest commerce. It replaced honest commerce. He talks about the obliteration of thrift, the increase in speculative gambling, the breakdown of morals. And to me, this sounds familiar. It sounds a little bit like our own predicament. So this is the progression of an investment culture based on a monetary policy that's built on an illusion. It's a kind of a magical thinking that ends up as mass self-delusion and dishonesty. Money printing and a misunderstanding of inflation leads many people to think that wealth creation is disconnected from the creation of real goods and real services. Because money, if it's practically free, investors are temporarily allowed to believe things like windmills can power steel mills, or that we don't even need steel mills. The illusion of wealth masks the declining productivity of industry, and it hides the creeping poverty that's coming along with the working class. When they're unable to save or move up the ladder, but they are coddled by increasing government handouts like the pandemic subsidies that give them some kind of temporary relief, many people simply give up on the virtues required to be productive members of an economy. This is the demoralization of the population that Hazlitt describes and that Andrew Dixon White describes. And I contend that this social condition is behind the wide acceptance of the phony story that was FTX and Sam Bankman-Fried, the bankster fraud. It's kind of a mass hypnosis that allowed his fraud to go undetected for years, while he was making fools of depositors, celebrities, and politicians and professional investors. All right. So I know I'm on a soapbox here, so I'm going to stop, but let's move on to finish up. What's the lesson? What can you do to avoid the pitfalls of an inflationary, speculative investment culture? I would say the first lesson is to always remember that inflation is not rising prices, but it's government money printing. Remember all the things money printing causes, and not just rising consumer prices. Training yourself to think in this way allows you to see many more results of inflation than just rising prices at the grocery store. By tracing as many connections as you can see that printing money gives an enormous arbitrary advantage to the early recipients of the money, that this dilutes the real wealth of everyone else, that money printing encourages everyone to get in on the scam so they can plunder everyone else because that's what everyone else is doing to them. That's the kind of perverse incentive that inflation sets in motion. So how do we restore the morality that inflation seems to want to take away from us? Okay. The civics lesson here is, I think, that we need to choose better stewards of our money. I would love to end the Fed entirely, but I have little hope that that's going to happen soon. At the very least, we need better politicians, more knowledgeable and more honorable politicians, and more honorable financial regulators. Again, I prefer to have no regulators, but that's not going to happen anytime soon. And now, in this regard, one immediate problem I see is that our better politicians need more knowledge of the monetary system and of the money creation process. I've noticed that the politicians and economists who best understand the monetary system, they tend to be social engineers. They're the collectivist types, generally not the free market types. On the other hand, the free market advocates generally do not understand money and banking as well as their political adversaries. They're outnumbered by, a bunch of amoral technocrats. So as citizens, I think we first have to educate ourselves about money creation and its consequences. We have to understand the current system before we can reform it. And as you know, that's what this podcast, Hard Money Jim, is always all about. But then we need to select and vote for better politicians who hopefully will appoint better regulators. And that's what we can do just in sketch form, is what we can do at the level of public political action. But I would say there's an equally important personal lesson for individual investors, a lesson that we all need to keep in mind as we try to make our way through this inflationary world. I believe the personal lesson to learn from the SBF fraud fiasco is to always the first thing is to always practice personal integrity in your own investing. And now, what do I mean by personal integrity? In the context of investing, there's a saying that you can't cheat an honest man, which I take to mean if you are honest with yourself, you are less likely to be fooled by a scam. And how do you stay honest with yourself? Well, you have to learn to be comfortable with your own knowledge and don't try to exceed it. Learn all you can, of course, and increase your investment knowledge as best you can. But no matter how much you learn, you'll never know everything about investing. I mean, that's just impossible. And in an inflationary world, the hype and the speculation around you will try to undermine your integrity and convince you that you can get something for nothing. Don't succumb to that. I'm saying you must stay within your own rational intellectual boundaries. Just because others seem to be making a killing, don't try to imitate them in some secondhand way. You cannot do better than your own mind. Actually, I think that's something Ayn Rand said. It's not her exact quote, but I'm not sure. I think that's where I got that. You can't do better than your own mind. That is, you can't do better than your own reasoning and judgment. So don't try to get outside it. It's all you have. Don't bite on a new investment idea just because someone else does. You have to stay first-handed and you have to make your own decisions. And as you go along, remember that ignorance about a particular aspect of investing is not stupidity. So don't think you're stupid for not being in on the latest investment fad, no matter how much your friends brag about it. And for example, if you don't know enough to buy stocks, don't buy stocks. By the way, many and perhaps even most investors today have no business buying or selling stocks, in my opinion. Now, if you hire an investment advisor or if you buy an investment fund, do it because the decision makers are an extension of what you already know, or at least what you could know. For example, if you're capable of understanding a conservative investment in a company's stock, but you don't have the time to research a portfolio of stocks in detail by yourself, there's nothing wrong with farming out that research to a well-vetted, trusted advisor. But on the other hand, if someone tells you they have a proprietary system of investing that can turn a 3% yield into a 9% yield with very little risk, like the LDI programs that scorched the British pension funds in December. Remember our discussion about that? If you hear something like that, remember you're entering that world at your own risk. So don't be surprised if you pay a high price. So to summarize this point, don't invest in what you don't understand. And that goes for stocks, bonds, options, crypto, meme stocks, anything else that's outside your understanding. And do not worry, please, about FOMO, the fear of missing out. That can be a very tempting pull. I have a saying based on many years of experience, and it's this: in investing, the chance of a lifetime comes along about every 3 months. About every 3 months. So keep your eyes open, stay within your own knowledge, and eventually you're going to find an investment prospect that is within your sphere of competence. Finally, I would say when evaluating investment, always start with true economic value, which means that the product or service in question has to be a win-win for all parties involved. Real investment involves real production. This means all parties to a transaction have to be better off after the transaction than before it. If you invest in a company that makes and sells widgets, for example, both the buyers and the sellers of widgets should be happy with their activities. This win-win approach requires appropriate transparency and complete honesty in all transactions. Now, let's see if we have time here. Let me give you an example of the opposite of win-win. After Bernie Madoff, you remember him? After he was caught and punished for fraud, many of his clients said that they knew all along he was cheating, but they went along with it anyway. And why did they? Because they thought Madoff was cheating the market, but not them. They knew his returns were too good to be true, but they assumed he was trading on, insider trading tips. And, they knew he wasn't making money due to superior investment analysis, but they thought he was merely violating regulatory rules, which would, and put him in jail if he was caught. But until that happened, the clients thought, well, they'll reap the benefits. They assumed that Madoff was sort of their personal Robin Hood, stealing from the market somehow. They knew Madoff was cheating in some way, but they thought, Bernie will never cheat me. But cheating them was exactly what Bernie was doing. Now, I expect some of Madoff's clients were innocent, but any of them who believed what I just described, that he was making them money by cheating someone else but not them, is both naive and cynical at the same time. Their desire to get something for nothing got in the way of their rationality. If they had started with a win-win premise, they would never have gotten involved with him. So if you're tempted to think you can legitimately make money by deceiving or cheating other people, well, you need to get your mind right. A real investment turns into genuine products that give genuine benefit to the world, and you should always remember that. Now, I have some other comments I could make. Examples of things that I avoid and why I avoid them. I'll just say briefly, I am not saying I'm right here, but I avoid all cryptocurrencies because I don't understand how they can be what they say they're going to be. I would love to find a solution to the fiat money problem. I would love it. I don't see how Bitcoin can do that. I think there are many issues that are unanswered about it. And because it doesn't make sense to me, I don't invest in. Many people I respect urge me to do so. They say Bitcoin, the best of the crypto lot probably, should be worth 100,000 or more. I don't get it. And if I don't get it because I'm too dumb to get it, fine. I'm happy in what I understand, and I'll take it as far as my mind lets me, but no farther. Okay. I have a similar feeling about investing in what I consider to be counterfeit ideologies. The organizing principle of many governments today is that we have to eliminate carbon dioxide from the atmosphere. That it's going to cause catastrophic climate change, and the future of humanity depends on doing this. And yet we know that carbon dioxide is a life-giving substance. We know that the levels of carbon dioxide in the atmosphere in geological history have been much, much higher than today, when the temperatures were much, much lower. So how can carbon dioxide be the temperature switch on which all of climate and humanity depends? It makes no sense to me. Therefore, I do not invest in carbon credits. I do not invest in carbon sequestration. Some companies you invest in just do this and you can't avoid it. But to me, that is violating my own rationality, and I will not do that. So it is an ethical issue to me, but it's an ethical issue because it's a violation of my mind. And so that's the way I think of it. And I think that's the way, I'm just saying, this is the way I try to maintain intellectual and ethical integrity in a world that wants to undermine. Okay, so I'm going to draw a line there. The broad point is, don't worry about missing out on the latest investment thing. There's thousands of legitimate investments out there with the permanence and scarcity and independence required for a good business venture. So keep your head, keep your integrity, be hard to convince, and don't succumb to FOMO. You will not always be right, but practicing rationality will lessen your vulnerability to the scam culture that breeds during inflationary times like our own. Okay. I'm going to stop there. And we probably have time for a few questions or comments. Go ahead, Daniel.
We have a super chat from Enric. Thank you so much. He says, thank you for the moral clarity on money.
Mm.
And then we have a...
Can I just make a quick comment there?
Yeah.
Right there on behind me, let me Stop share. Right there behind me, you see, oh, right there, that is Francisco's money speech. And I take it quite seriously. So I appreciate your getting from me that sound money is a totally moral issue. So thank you for that comment. Go ahead, Dan.
And we have a super chat from Free Trade. Thank you so much. And those are all the super chats.
All right. Okay, so if I can figure out, I need to get better at this, Daniel. Okay, if I can, I wanted to put my info up there as usual. Here we go. You can find me at Hard Money Jim on Substack. Subscription is free. I've gotten a little behind on my essays. I'm going to remedy that in the next couple of weeks. I'm on Twitter, but not very much, mostly to get information rather than to give it. I'm on LinkedIn, where I also post these essays. As I mentioned last time, I had an essay printed in Capitalism magazine, which I recommend. It's a good one. It's also free, run by a gentleman named Mark DaCunha, who does a good job collating good sources. All right, that's that. And I don't know if I'm going to be back but before the end of the year. I will certainly put out an essay, but I'd like to get back and do another one of these. If something really interesting comes up, I'll try to do that. And with that, cheerio, everybody, and have a wonderful weekend.